invited here either from somebody that took an interest in you and you have an interest in the business and or our services, or just want to take an interest in person that invited you here. Either way, you're going to get a lot of information. It's not to overwhelm you, by the way. So, and if you want notepads and pens or paper, we can get them to you because you're going to learn a lot. In fact, what you're going to learn is what you should have been taught way back when you were in grammar school. I mean that sincerely. We're basically here to disturb the comfortable and absolutely make comfortable the disturbed, right? So it's both. And it's all about money. It's about the knowledge of it, which you don't have. I challenge everybody in here to challenge us tonight and listen and learn our story. Don't get over it. It's a lot of information, but we just feed it to you a little bit. And if anything, just open up your eyes and we'll see where it goes from there. We're going to ask you to shut off your phones, if you will, or put it on mute and quiet like my own, okay, because that will invariably ring it. I need to do it right. And because we want your undivided attention, because it's going to be worth it. And when I said we're here to disturb the comfortable, when you find out what you haven't been told and what we didn't know, it should be disturbing, okay, from the data that we give you. So we have a crusade here. There's several of them, and it's a lot of fun. We have fun at what we do. That's kind of neat, too. And you actually can earn money doing this. So we ask you just to take some good notes if you want to. That's great. And we ask you also, if you ask us a question, how many of you want to get an answer? Anybody in here? So we expect the same thing. If we ask questions, we want you to reply. This is an audience participation, if you will. Do you have to? No, but we'd like you to, because it's an open conversation with the story that we tell you. So, and we also, by the way, while we're doing this here with our guests and the people that are in the business, we're also televising this, and this is going nationwide, and several people tune in that are in other states right now. So it's not just yourselves, there's other people tuning in, which is great, and part of this state and other states. And so without any further ado, we get right to work. I want to introduce the speakers to you, some young men that are building their business right here. And the first one came to us, and he'll tell you his own story, but he was a teacher, left teaching, is now come from Memphis, Tennessee, formed his own nonprofit also for education for kids, and used the power of rugby, the sport, to do it. There are a bunch of athletes in here that play the sport of rugby. And as a result of his teaching experience, then he got into this business and is relocated down here to Florida to work in the business full time, which is pretty good. And he's learned an awful lot in the last, I'd say, 18 months. And so I'd like to welcome, he's an MVP, just won a trip, all expenses paid, which is pretty good in the company, to Puerto Vallarta in April. So that's pretty nice. So we do a lot of things like that too. So if you're going to have trips and vacations, don't pay for them, let the company do it. How's that? So none other than Shane Young. Can you welcome Shane Young up here?
That was quite a grand intro. But the truth is, I taught elementary school, and when I taught English, so I was born speaking English, that was easy. But then I had to even look up what an adjective was when I had to teach them what adjectives were. So some of you are smiling, but I bet you would have had the same thing. So I'm here to give you the simplest part of the briefing. So we're going to start very easy and very simple, because I'm just not that smart. So I'm going to give you the part that I can understand easily and all you can understand. And the truth is, we've had people come in here to learn from us, to explore an opportunity to gain some knowledge. And some people come in here and they don't really know what for, just a friend invites them and whatnot. But we've had presentations that we've done for doctors, CEOs, all the way to landscapers, truck drivers, and people from all kinds of professions. So blue collar, white collar, doesn't matter. We are here to talk about money and finances, and we believe that that's just one language across all professions, because the rules don't change depending on who you are. So we're going to start with 6 real simple rules. I said this is the easiest part. This is the simplest part. So take these notes down, because I want you to look at these 6 steps and think about them in your own life. So there's only 6 of them. They're all very simple. I think you'll agree that you should have them relevant in your life today. And I challenge you to think about if you do or not. And we'll walk through them, and you're welcome to ask any questions or make any objections at any time. So they're the 6 steps to financial security. Okay? So are you financially secure? By the way, if you're missing one of these, I call your plan and your future Swiss cheese, because Swiss cheese has what? Holes in it. Holes, right? So if you're missing one of the 6, there's a hole in your plan, there's a hole in your future, and we believe that that's a dangerous place to be. So number 1's really easy. Trey, what's number 1?
Increase cash flow.
Increase cash flow. Does anyone not want to increase cash flow? I've never heard anyone say, no, I would like to have less cash, right? So increase cash flow. There's 2 ways to do it. And here is where people differ sometimes on this. 2 ways to increase cash flow are: 1, to make more money. That's what Trey's always trying to do, right? Make more money. And the other way is what everybody's going on Yahoo News to try to find out how to do, is cut expenses, right? People are always trying to learn. There you go. Got one more guy coming in. He's at the door now. So make more money or cut expenses. Both of those things increase cash flow, don't they? Increases the cash flowing through your system. Everybody okay with number 1?
Yep.
Okay. Number 2, establish an emergency account. Again, really, really easy, really simple. No one's ever saying, I don't need that. However, a lot of people say the wrong thing because they think they have an emergency account, and really it's a savings account. And we just coach people. We're actual coaches. Like Coach said, I used to coach rugby, and a lot of us are athletes, and so we coach people. We don't tell people what to do. We don't beg anybody to be wealthy. We do encourage everyone to try to build up an emergency account that is at least half of your annual income. It means if your annual income is $40,000, hey Rick, you have $20,000 saved up in an emergency fund. Okay. Number 3, manage and eradicate debt. Won't spend too much on. Anybody know somebody with debt? Everybody has debt or knows somebody with debt. Okay. It's a horrible thing because if you talk about mortgages, if you talk about credit cards, interest is something that the average American just doesn't understand. So people go into debt and they borrow money and they end up on the hamster wheel of debt because they just truly don't understand how compounding interest works. So we're out to teach people the simple rules of things like compounding interest that the big institutions, banks, mortgage companies, credit card companies, they've been using to become wealthy for years. Average Americans usually don't understand those things. Some people do, and we're going to treat it the same no matter what. So we're going to show you some videos tonight to explain how we do number 3, which is manage and eradicate debt. Number 4 is ensure proper protection, EPP. Okay, this is my favorite one because it shocked me when I first heard it, because the way we explain it is so unique. What do we insure in our lives? What are the things we get insurance on?
TVs.
What? TVs, yeah. TVs, phones. Really, we get insurance on anything in our life that is expensive, important, right? But we don't want to lose it. So TVs count, phones count, but we get it on our cars because we got to follow the law, right? We get it on our home because we got to follow the law. Even we get it on our health now to be within the confines of the law, right? So don't pay that penalty anymore under the Affordable Health Care Act. So we insure everything that's important to us except for one thing. What's the one thing we don't insure, Ken? Sort of, yeah. We do get, some people get life insurance, right, to insure their lives, but we don't insure our income. The only way we insure our income is clocking in or filling out a timesheet, making a sale, getting commission. Those are the ways we insure income. For most people, if they couldn't go to work or they couldn't function as a professional, they wouldn't have income because they didn't insure proper protection. We show people how to do it just like the professional athletes do. Some pro athletes have really good arms, quarterbacks, pitchers, really good legs, soccer players, right? They get specialized insurance policies on those body parts because that's the source of their income. You don't have to be a pro athlete to EPP. We show people how to do it, even if you're just if you work at the ice cream store, you can still insure your income. Even Jennifer Lopez got a specialized insurance policy on her butt because it's a source of her income. Seriously. So I tried to be the agent for her, but she wouldn't. She didn't accept. So number 5, and we're almost done, is build long-term savings. So building long-term savings is something, again, everybody knows they should do, everybody strives to do, and yet we coach people to think in a different way, make a mental adjustment. So what is it? How can you build long-term savings faster and accelerate? Well, we just call it pay yourself first, okay? And we start by looking at our paychecks. When we get paid, what happens to our money? Well, for most people, the first thing is the mortgage or the landlord, right? Rent. Then groceries maybe. Then car insurance. The bills, right? And then whatever's left, if any, comes to us and our families. That's the way most people live, especially paycheck to paycheck folks, right? That's just the way it is. And I'm not suggesting that you go live off the grid or, stop eating a normal diet. I'm not suggesting you move into a mini home. You know, those mini homes are like a trend now. People are moving into these like 50 square foot homes. They're pretty cool, actually. And so I know we have a guest from Tampa on the computer, and she's kind of like a hippie, so she might like the one home. Sorry, Ashley. But she's not even here to defend herself. So, but build long-term savings means pay yourself first. So make a commitment. If you have to make a mental shift, do it. Pay yourself first just means, the landlord, the grocery store clerk, they're not going to go to you later in life and say, Joyce, you came here, you paid rent for so long, you bought bread from Publix for so long, we're going to pay you back now, like 20 years later. It's not going to happen. Only you can count on yourself to pay later. So pay yourself first, make a commitment. It's more of a mental shift than an actual functional change. So everybody good with 1 through 5 so far?
Yep.
Okay. Number 6 is the last one, and it's preserve your estate. Won't spend too much time on this. I'll tell you this, though. I started on the theme that I wasn't that smart. I'm telling you it's true because I used to think that an estate was just a huge home my whole life until I learned this business, and I found out that an estate is just a simple combination of what you own and what you owe. So not everybody's estate is so hot, right? Not everybody's estate is a big house. Some people's estate is debt, okay? Pretty bad planning. They probably had Swiss cheese. So preserve your estate is what we do for people to estate plan and make sure that when a loved one passes on or when we pass on, that our families and us, we don't have to face lawyers, judges, tax attorneys, because everybody here, a lot of people here know, I'm sure, that even when you're dead, the government wants to tax you, right? What is that called? What kind of tax is that called? Anybody know? Death tax or inherit? Yeah, if you inherit money, then that's tax too. So we teach people how to avoid those messy situations. Any questions, anybody, on the 6 steps of financial security? Did you think about it in terms of your own life? Anybody? I always do. So there's your BLT for build long-term savings. We like acronyms. That's for being an elementary school teacher. So who are we and what are we doing here? We're called Empower. We brand ourselves as a consumer advocacy group. We started out years and years ago actually not doing finances, not teaching people about money. We were helping people in a different way, just sticking to consumer advocacy, and we're helping people save money on utilities, right? In some states, in fact, there's 14 of them right now in America, you can choose who to pay for your utility bill. And you can save money because doesn't competition drive down prices, right? So we took advantage of that, and we wanted to help people save money on utilities. That's great. And I'm from Tennessee, not a deregulated state, so there's a monopoly there. We couldn't do it. Here in Florida, it's a monopoly. You got to pay FP&L. Can't do it. So we've moved on, and we found a lot of different changes in the financial climate in our country, and the way things have changed have guided us to be consumer advocates in a different way. So we like to educate people on some of the things you'll see right on the board here: investments, stock market, insurance, protecting yourself. So anybody ever seen this magazine? Anybody subscribe to it? Consumer Reports. This is a nonprofit organization that just rates products. So whatever it is, a car, a toaster, a TV, a laptop. I used their ratings to choose my laptop. I just wanted something, reliable. I didn't really care to spend that much money, nothing fancy. So that's the way you can use Consumer Reports. So we don't work for a certain company. We compare ourselves to Consumer Reports, not because we're nonprofit. However, we are, we're independent. We're not married to any specific company. We're contracted agents with many companies, some of the biggest ones in the country, and we can go around and shop and tell people what's best for them based on a wide range analysis. So that's what Consumer Reports does for a range of products. We do in the financial world. Okay, so we call it a crusade because there's some things that go on with people's money that we find to be criminal often, and you'll learn a little bit about that with our next speaker. And these are some of the areas of focus. You can just glance at them before we move on. Okay. So last thing I'll talk to you about is how do we protect people's money, and how do we grow money, and how do we make it work for us on all fronts? So again, do you guys, anybody like sports? Do you like sports? Nobody's an athlete. Ken more than like sports. Ken's like the jock. He was like the high school guy. Like stuffing people in lockers that didn't play
I
football.
was in power. I was in honors class.
No, he's actually a brilliant guy.
Power nerd. Never heard
Swirly.
He was the
Frank Hall.
he was the jock that was like in like a nerd on the low. You know, he didn't want anyone to know. So it's okay, Ken. It's okay. So you all might not know who it is, but I know Ken knows who it is. Bear Bryant. You know Bear Bryant? Heard the name? Yeah. Famous football coach, coached Alabama, Texas A&M, and Maryland.
For 1 year,
Wow.
yeah.
Thank you for being here, because I never say that. Now I'm always gonna say that, because there's gonna be some Maryland fan that's like, yes. So Bear Bryant coined one of the most famous quotes in sports and in life, I think, which is offense sells tickets, defense wins national championships. And he won 6 of those. So I think we would listen to him if he says something like that, right? So offense, the fans want to see the touchdowns. That's what sells tickets. Defense is what wins the games, though. So we start out by doing this in finance as well. Defense. I always say, if you ever become a rock star, you win the lottery, or you make a ton of money, you better learn how to play defense, because people who make a lot of money gain a lot of cousins, uncles, and aunts, right? Don't you?
Oh, yeah.
Because everybody wants something when they know you've got it. So you want to play defense. But even if you're not filthy rich multimillionaire, you still need to play defense against these things. So watch. Number 1 is market loss. Today was a roller coaster. Anybody watch the stock market today?
No.
Yeah. It was a weird day. And really since November, since the end of 2015 to now, the stock market's been really unpredictable and crazy and drastic. It's broken records negatively. And today it was taking a beating in the morning, and then it came back in the afternoon. It was weird. But anyway, I'm not here to try to explain or figure out the stock market. All I know is if I'm earning money and working so hard for it, I'm certainly not going to subject it to that roller coaster. So we teach folks how to defend against market loss. The next thing is fees and commissions. So just a quick story. As a teacher in Tennessee, I taught in the inner city, so rough area. Worked really hard. It was a great experience and something that was extremely challenging. And despite all that, and my sob story, I really loved it, so I'm not sobbing at all. However, the state of Tennessee takes money from teachers involuntarily. It's not a choice. And for me, it was $80 every paycheck, so 2 weeks. So $160 a month to a 401k program with Tennessee Consolidated Retirement System. Great, right? They didn't even match it, but great. They're saving money for me, as if I don't know how to do it myself. So fees and commissions, for me, there was somewhere between 12 and 18 of them. By the way, that's normal for a 401k. 12 and 18 different fees. What marketing fee, administrative fee, management fee, you name it. There's between 12 and 18 of them, and it adds up to about 3 to 5% over the lifetime of an account. Okay? And you could fact check that. That's average 401k. And then for me, I didn't even know I was paying into it until I woke up 2 years into teaching. I was, where's all that money going to? I checked the account. I had like $7,000 in it just from working. And then I came down here, wanted to buy some, property to live somewhere, and wanted to take it out to make a down payment. Found out that to do that before I'm 59, I'm pretty far from 59. To do that before I'm 59, I have to pay 20%. Eat it, right? Just money that I earned, gone. So those are fees and commissions. Folks that have 401ks, IRAs, any type of qualified account, they pay those fees and commissions to people that I call Broker Joe and Broker Sue, because they keep you broker, right? And you don't know them, they don't know who you are, and they get paid in the form of fees and commissions, whether you win or whether you lose. It's an interesting scenario that people, voluntarily, or like me, involuntarily take part in. We teach people how to avoid those things. And finally, we teach people how to play defense against taxes. Okay, so it's a simple question. We'll explain this, but if you could opt out of the tax system for your retirement, right, protect your retirement from taxes, how soon would you want to know about it? By the way, completely legally, morally, fiscally sound, how soon would you want to know how to protect your retirement from taxes? Probably yesterday, right? So we teach people how to play defense against those things. Offensively, so offense sells tickets, right? The first two go hand in hand. Growth and income. When's the best time to grow money? Anybody know? When you're making it, when you're earning it is the best time to grow money, not when you need it the most. So you got to have income. You got to have growth. You work so hard for money, sweat equity every day. You better have it working for you. I think everybody can agree on that. And not finally, number 3 is safety. So we're going to show you a mathematical rule next. Some of you might have heard about it. It's called the Rule of 72. And it shows why safety, if you're really paying attention, I know when I saw this, I scratched my head and said, why is safety on offense? Shouldn't it be defense, right? Safety, right? Protect. But when you see the math and how compounding interest truly works, you understand why safety, and if you ever lose money in something like market loss, you also lose offense, and you lose the ability to grow money forever. It's called compounding interest. We'll show you how that works next. Next is liquidity. Anybody, Rick, can you explain liquidity in a brief 1 or 2 sentences?
Yeah, well, you have money in some kind of a fund or some sort, you want to be able to take it out and not have it locked up as a CD, or when you want it on the money market, you want to have it liquid. You want to be able to take it.
Right. So true liquidity is free and clear access to your money. Shouldn't everybody have liquidity? Is there any reason, unless you're convicted of a crime, that you shouldn't have access to your money? Everyone should have liquidity. Okay. And with me and that 401k I told you about, no liquidity until I'm 59 and a half, or willing to pay thousands of dollars for it. Crazy. So we teach people that liquidity is something you can have, and I believe it's one of the most important things you should have. And finally, tax efficiency. We talked about that a little bit. We'll explain it more tonight. We'll even give you the IRS tax codes that we operate under to make sure we can keep our retirement out of the tax system. Okay? So before we go on anymore, if you have questions, please ask. We're going to bring up I almost said future scientist, a former scientist who was a scientist in the state of Florida, who's going to kind of give you that math behind what I was talking about with safety and compounding interest. It's really incredible. And it's this guy on the computer. That's Ryan. Give him a round of applause. Yeah.
So I'm Ryan. Once a scientist, always a scientist. That's how it works, right? So yeah, I used to be a biologist for the state of Florida. I got my master's over at FGCU in environmental science. I'm not doing that quite anymore, but I do a lot of outdoor activities, and thanks to the opportunities that this company has granted me, I now do kayak tours and things like that for fun, which is great. I love it. And the other thing I'm really passionate about is this. I'm a numbers guy, so numbers, science and numbers go hand in hand, right? So the rules of the money game, we got to know them in order to operate in the world of money, right? You know, if we don't know the rules of the game, you can't play. You lose automatically. When you go to the lake house and you whip out a board game that you never played before, it's the first thing you take out of the box. Instruction manual, right? You read the whole thing. So what we got to learn is the rules of the money game. Actually, I read an article today talking about how little they teach kids in America about personal finance. We shared it on our Facebook page if anybody saw it. So this is something that we should have learned in elementary school, and I actually was fortunate enough to learn it with jelly beans in elementary school. It's that simple. So here we go. That guy, anybody recognize him? Greg, you recognize him? Who's that guy?
Albert Einstein.
Yes, Albert Einstein. Pretty smart dude. Would you agree?
Yes.
Yeah. You seemed unsure. Well, he came up with a lot of stuff that government.
He hijacked the theory of relativity from somebody else.
Yeah, right. Well, he got all the credit for it, so he did something right? So he came up with, a lot of the rules that govern modern physics, and he also came up with the rule of 72. Has anybody heard of that here before? Rick, I don't know if you haven't been here. Okay, so rule 72. He said that this was the greatest mathematical discovery of all time. Now, whether he stole them or came up with them, we don't know. But coming up with all those other mathematical laws, don't you think we ought to pay attention to this one if he's saying it's the greatest one? Obviously, right? So what it says is how money doubles with compounding interest. And the simple way to calculate it, the equation is much more complex and spread out, but simplified. You take the number 72, which is the constant, you divide whatever interest rate you're either earning or paying into 72, and the result of that is how many years it's going to take for your money to double. So if you were getting a 1% interest rate on an account, you take 72 divided by 1. What's the answer to that? 72. So that means it'll take 72 years for your money to double on itself one time. Everybody with me?
Mhm.
All right, cool. Moving right along. So today, I want to make you guys the deal of a lifetime. You're all 23 years old. Cool? You guys okay with that? Alfred, are you okay with being 23 years old today?
Sure.
All right, cool. You're 23. And you're coming to my bank. I just opened up down the street, the International Bank of Ryan. And you're going to come and deposit $5,000 into a savings account. Okay? So you're 23, $5,000. I'm also going to give you 2% interest on your savings. So Ken, what are banks paying these days at regular savings accounts?
Nothing, right? It's like
0.03.
0.03, right. I was with Rick yesterday and we discovered we always use 0.02. It's actually 0.03%, which would probably take you about 3,000 years or more to double on itself just once. Right. Yeah, right. Well, not a savings account is, it's just a regular savings account. But I'm going to give you 2%. So I'm literally giving you 200 times what the banks are going to pay. I'm also going to give you a gigantic flat screen TV just for opening an account with me. Are you coming to my bank, Ken?
Yeah, sure.
All right, yeah.
I need a TV.
Yes. My first customer, 23-year-old Ken Dunn. All right. So you're 23, you come to my bank, you get the TV, you deposit $5,000. 36 years later, because 72 divided by 2 is 36, right? So doubling time is 36 years. 23, give me a click. Then you're 59 years old, 36 later with 10,000. And when you're 95, hopefully you're not pushing up daisies, you have $20,000 in the bank. So Ken, what are you going to do with that $20,000 when you get to 95 years old, 70 years from now?
Buy Depends.
All right. Feeling optimistic. Beer. Okay, good. Well, this is the point that I'm trying to make. A lot of people go and say, oh, I'll buy a car or a motorcycle or something. And today, what does a brand new car cost? About $38,000 on average, right? 70 years ago, what did a brand new car cost? About $1,000, right? For a brand new car. So 70 years from now, do you think you're going to get a car for $28,000? No way. You're probably going to pay $100,000 for a brand new car 70 years from now. So your $20,000 sitting in the bank is going to buy you, Ken, a six-pack of natural life. So enjoy that. And, woohoo, there's a little sarcasm built into this presentation. So I'm going to sweeten the deal a little bit now. Bank of Ryan is going to have a special this week. We're going to give you 6% on your money instead of 2%. So you're the same 23-year-old coming into my bank with the same $5,000. Give me one click. And now I tripled your interest rate, right? So I went from 2 to 6, tripled it. Then I took the doubling time and I cut it into 1/3 of what it was. So Greg, if you come to my bank and you deposit $5,000, here you had $20,000, tripling the interest rate, cutting the doubling time to 1/3. What are you going to have at 6% at 95 years old over here? Just take a shot.
Well, 10 at 35.
Don't do the math, just guess. This price is right.
40,000.
40,000. Tony, what do you have? Just take a guess. You got to go higher or lower. 50,000. Alfred, you got a guess? The question: when you get to 95 at 6%, all I did was triple the interest rate. How much money are you going to have in that account? $1 million. Get out of here, Rick. How much? 150. Okay. Ken, have you seen this? Are you cheating?
I saw it, but I saw it kind of just wrong. I would guess lower. I would have guessed like 60,000.
60,000. Okay, I'll take it. All right, so I'm gonna make you guys all a deal that took a guess. I'm gonna give you the TV, any flavor of lollipop that you want. I'm gonna give you the money that you want, and I'm gonna keep all the change. And that's just the rules of my bank. So I'm sorry if you don't like that. So here we go. 12 years doubling time. Just play it out for me. So by the time you are 95 years old, you have $320,000. So far exceeding the guess, right? But it's crazy to think about it. It's surprising, right? Because if I'm only tripling the interest rate, how am I gaining $300,000, right? That's the power of compounding interest. Because we're not just tripling the interest rate, we're cutting the doubling time down. So your money's doubling on itself at an exponentially higher rate, right? So that's shocking. And I'm going to sweeten the deal one more time. This is a one-day sale. You got to come into my bank today for this. I'm going to give you 8% on your money now instead. So you're the same 23-year-old, the same $5,000, and this time all I did was increase the interest rate by 2 percentage points. That's it, just 2. I'm not tripling it. I'm only going up 2%, and then I'm cutting the doubling time down by just 3 years. That's it. So if I have $320,000 over here at 6%, I only add 2%. How much am I going to have at 95 years old? What do you got, Greg? Take a shot.
$500,000.
$500,000? Okay, Tony.
Let's say 700,000.
700,000. All right. What do you got, Alfred?
900.
900. Ken?
Yeah, million.
$1 million? Okay. All right. I'm gonna make a deal with you guys. You get the TV, you get the lollipop, you get the money that you wanted, and I'm keeping all the change. Cool? It's cool for me. I like it. All right, let's go. Play it out. Survey says at 95 years old, you have $1.28 million. So Ken, you felt like your guess was pretty close this time, right?
Yeah.
Yeah, but you still paid me $280,000 for that television set, right? It's funny, a lot of people, they feel like they guessed closer on this one, but really the amount that they were off was even more than the last time. So if you guys ever want to buy a TV from me, let me know. I will sell you TVs all day for $280,000 or more. So here it is. That's shocking, isn't it? So how is it the banks are paying what, Rick? 0.03?
Yeah.
0.03. So I'm paying 100 times what the banks are paying, and I'm going to give you $20,000 when you're 95 years old. What do you think I'm doing with the money that you put in the bank?
You're investing in it 12%.
I'm going over here to B, right? So if you had your choice, what would you rather? Would you rather A or would you rather B? B, right? Because that's where all the money is, obviously. So what we call this, give me one more click here, is legalized extortion. That's a strong word, isn't it? It's like a gut punch when you hear extortion. And that means theft. So what do I mean by that? They're taking the money that you put in the bank. Like when somebody gets a paycheck, where does the first place that it goes? The bank, right? Direct deposit half the time. You don't even see the money. It goes straight into their hands. Why do we do that? Convenience. That's what we've always known that was the right thing to do, right? So we put it in the bank. Then the bank takes the money that we put in the bank, and then they go lend it to somebody else, right? Who has a credit card in here? Any percentage rates? Anybody want to throw some out? 17?
12.5.
12.5? Nice. I guess 17, 18.
They just raised mine after I did a claim on a car, but at 8.24, I think, 8.24.
Okay, all right. Well, the highest is 33%. So think about this. Think about that in terms of Rule 72, right? 72 divided by 33 is what? It's about 2.2. That means the banks are doubling their money every 2 years on the people that they're lending your money to. Then if you want to go buy a house, what do you got to do? Go take out a mortgage, right? So you take a mortgage out, you pay somebody for 30 years of your life, and then what happens? They're gaining interest that entire time on someone else's money. So how is it even legally or morally okay that they're going to give you $20,000 and they're going to keep $1.26 million that could very well belong to people and their families? Easily. 8%, that's attainable. You know, that's not impossible over there. And we're going to talk about ways to achieve that also. Yes, Shane.
Just to make this relative to like everybody, I had a meeting yesterday with a college educated person who had 2 credit cards, both near maxed out. Wasn't surprised by that, but didn't know that both interest rates were north of 25%. And had been paying into them and just not paying attention, not worried about, not realizing why it's taking so long to get out. College educated person.
Right. So it's, you know, that's an epidemic in our country. Debt is an epidemic. So the Rule 72 is a powerful thing if you know what it is and you know how to use it, right? Because we want it to work for us and not for everybody else. So currently, you know, we all said already that we either have debt or know somebody that has debt, right? So we got to help figure out how to make the Rule 72 stop working for everybody else and then take it back in our hands and start making it work for us and our families and our loved ones, right? So the first thing we're going to attack is debt, right? That's a drag. Nobody likes it. We want to stop that effect. and then put it back in our hands. So what I'm going to show you right now, really quickly, is a very short video about some of the things that we do to deal with debt for people, and then I'll explain it right after I show it. Oh, it's right there. Look at that.
Did you know that millions of Americans are overpaying their mortgages? And not by a little, by tens of thousands, even hundreds of thousands of dollars. That's right, and it's all in interest payments. The fact is, most Americans could be living the lives they've always dreamed of if they weren't spending the majority of their adult lives paying for the lives their lenders have dreamed of. In this video, we're going to show you how overpaying your mortgage is robbing you of the future you could have, and what you can do to stop paying for somebody else's dream and start turning your financial dreams into reality. So let's get started. Meet Bob and Katie Smith. The Smiths own their own home, and they're in a pretty typical mortgage situation for millions of homeowners across the U.S. Your individual mortgage details may differ from this example, but the financial principles remain the same. Bob and Katie have a 30-year mortgage for $200,000 at a 4.5% interest rate and a monthly payment of just over $1,000 per month. Bob feels like they're pretty lucky to get a 4.5% rate. I mean, that's a great deal, isn't it? Well, to answer that, let's take a closer look at that 4.5% interest rate. How much of the Smiths' payment every month is going toward interest, and how much is going toward principal? By the end of the first year, they'd paid their lender more than $12,000. Of that, nearly $9,000 went toward interest. That means that over 73% of the money Bob and Katie paid their lender in year one went toward nothing but interest. That's 73% of their payments up in smoke. And in year two, it doesn't look much better. Once again, Bob and Katie paid their lender over $12,000, and of that, more than $8,700 went toward paying interest. That means that in year two, over 72% of the Smiths' money went toward nothing but interest. Now let's fast forward to year 20. By year 20, Bob and Katie have paid over $243,000, but they still owe their lender over $97,000 in principal on their loan. That means that after paying all that money, the Smiths still owe almost half the original amount they borrowed. And by year 30, the amount Bob and Katie have paid their lender totals almost $365,000, of which nearly $165,000 went toward paying nothing but interest. That means that they've paid their lender over 82% of the amount they originally borrowed, just in interest payments. That's 82%. Quite a far cry from the warm and fuzzy feeling the Smiths had when they heard they got a 4.5% loan. So where do all the billions and billions of dollars homeowners are paying the banks in interest go? Exactly. Homeowners like Bob and Katie from all across the nation spend their lives making interest payments to the banks and wonder why they never get ahead. But guess what? It doesn't have to be this way anymore. What would you say if someone told you that there is a simple online banking solution helping homeowners like you put an average of 18 years or more worth of mortgage payments back in their own pocket? How excited do you think people like Bob and Katie would be if instead of having to pay the bank over $164,000 in interest payments, they could pay less than $63,000, the same amount of interest they would pay if they had just a 1.9% fixed rate on their mortgage? That's nearly $102,000 in interest payments they would save, and their house would be paid off free and clear in just 12 years versus 30. Thanks to our online banking solution, Bob and Katie would be done making mortgage payments in just 12 years. What could you do with over 18 years of mortgage payments you no longer had to pay to the bank? Just imagine the possibilities. And you don't have to refinance. You don't have to change banks. You don't have to increase your minimum monthly payment. And you don't have to modify your mortgage or change your mortgage terms in any way. Just imagine the freedom you would have if you no longer had to make mortgage payments to anyone. Don't waste another minute. Watch the corresponding overview.
All right, we're not gonna watch that right now. You're welcome to later. So isn't it kind of shocking that when somebody buys a home, you know, they get a stack of papers this thick, right? They go through the stack, sign, 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 sign. All they hear is the jingle of the keys, right? That's what they want. That's what we all want, right? It's the American dream, buy a home. What we don't want to do is pay for 2 houses when we're only getting 1, right? BOGO for the mortgage companies, right? We don't want that. So what we're working to do is to stop that. Now, this was focused on mortgages, but what we've helped develop here is a GPS system for your whole financial life. So it doesn't just work with mortgage, it works with all debt, credit cards, student loans, mortgages, car payments, everything that you got in your whole financial life. What this is, it's GPS system. Like, how did you get here today? How did you guys get here today? Using the GPS, I suppose? In your phone?
Originally.
Originally?
Rick plowed the way.
Right. All right. But when you don't know where you're going, that's what you do, right? Usually you put it in your phone, you put it up on your dashboard, and what it does, it tells you how to go from A and get to B. Exactly how to do it. It's going to tell you exactly how long it's going to take you to get there too, right? And if you take a wrong turn, it brings you right back to the route, and you get there at the exact time you're supposed to get there, right? So that's what this is. It's for your financial life. It's a full-time coach that we've helped develop over the years, and the results of it are exactly what they're saying. And just for an example, I've had a client that had about $200,000 left on a mortgage, $70,000 worth of student loans, and about 10 different credit cards with small balances here and there, 100 here, 100 there, you know, they add up. And so he had a total of about $250,000 worth of debt. Going the way he was going to end up paying about $220,000 worth of interest payments on top of that debt that he owed. Did he realize that at the time? No, because he's going about his life. Life happens. He's paying his bills. He's existing, right? So I showed him that, and he was pretty shocked. And thanks to running into me now, we put him in the system. And rather than being in debt for the next 30 years and paying that much interest, now he's going to be out in 7.2 years, saving himself almost $200,000 worth of interest payments. So that is profound. By following a simple set of instructions, it's like a recipe. You follow the instructions day by day. It tells you exactly what to do. It's not like those things online that tell you what you already did. This tells you exactly what to do, exactly to get you the end result. So it's very profound. There's nothing out there like it. And it's really making a difference to help people free up money, stop making the Rule 72 working for everybody else, start making it work for us. So what do we do when we get people out of debt? Then how do we go get that 8%? How do we make sure we apply our 6 steps to financial security and then apply our offensive and defensive strategies to people's lives and help them not only eliminate debt, but then build their financial future to get to where they want to be? Because that's important, you know, especially today with, you know, in our generation, it's, you know, people don't save. They don't think about these things. They don't know where to go, what to do. Everybody's saying something different. So what we want to do is give them some guidance and some options and give them an overview. So where do we go? I'll show you a quick video. This one's about 3 minutes with an intro to some of the things that we do to help satisfy all of our strategies.
Hey, thanks for joining me here. I wanted to give you a quick snapshot on what it is that we're doing. This is a snapshot of our program, Red Line, Blue Line. Not knowing anything about anything, if you had to choose one of these 2 lines to put your money on, would you choose the red line or the blue line? The blue line, of course, right? Because it's more money. If you look closer, what you realize too is that it never goes down. It only goes up. Never go backwards. Gains are locked in. But you know, the story gets better than that. In addition, that $211,000 is income tax free. The red line is the Standard & Poor's 500 index. That's the stock market. 500 of the largest stocks in America. And if you look at this 165, about 95% of mutual funds do not outperform the Standard & Poor's 500 index, meaning that most people in mutual funds, 401ks, IRAs, so on, actually had less money than the 165. But we still have to deduct fees because fees didn't come out of this. The average fee is about 3%, can be anywhere between 1.5% to as much as 5%. Many people aren't even aware that they're paying these fees because they're hidden in what looks like a phone book of written by a Philadelphia lawyer called a prospectus. But when they examine that, the Los Angeles Times said the average is about 3%. And in this case, on $100,000, that would be about $3,000 a year in expenses that you have to pay, by the way, whether you make money or lose money. And if we just roughed the numbers out and said $3,000 on $100,000 over 15 years, means you'd have to subtract $45,000 out of this number. But we still have to take taxes out. And if you even looked at a 10% or 15%, 20% tax bracket, very conservatively, you're about where you started 15 years earlier. Now, you put up 100% of the money, took 100% of the risk, and ended up about where you started 15 years later. I want you to think about this. The mutual fund company put up zero money, took zero risk, and they made $45,000 in the process. $17 trillion today is on the red line in qualified plans. That's 17 trillion with a T. Without anyone spending one additional dollar, don't you think that most people would prefer to be on the blue line? In addition, this comes with all sorts of other benefits. This is net of fees, charges, expenses, and it's also income tax free. So here we have a smarter, more complete alternative to 403b, 401k, IRA, mutual funds, to the stock market, where you don't have the risk. By the way, that $211,000 is guaranteed never to be less than that. It can only go up, never go down. In addition, there's other benefits that come along with it. When you look at the whole package, it's, again, a no-brainer.
Okay, so before I go into blue line and all that stuff, if you had your choice, would you choose the red line or the blue line?
Blue.
Blue, every day, right? Obviously, it's one of those rhetorical questions again. So from that video, a lot of the themes we've already talked about tonight were brought up again, right? We talk about market volatility and market loss. We talk about fees and commissions. We talk about taxes, all the things we got to defend against, right? Then we talk about requiring growth to get to where we want to be. We want to have safety. We want to have liquidity. We want to be tax efficient in our savings. So this red line right here, like he said, that's the S&P 500. For those who aren't familiar with that, that's the top 500 companies in the country, the main index that we really go by to gauge how our economy is doing in the United States. Top 500 companies in the country, the strongest, the biggest, the best. So the majority of people's retirement savings are here in this red line. And just like Shane said, today was an insane day in the market. Never should you see money fluctuate by 1% to 2% per day on a daily basis. That is completely insane. That never happens. It's happening right now. It's volatile like this. And if you look at the history of what's going on, back here in the 70s and the 80s, the line looks like this, a very gradual upward slope, changing maybe 1% to 5% per year, nothing crazy, upward trend the whole time. Then you get to the 90s and the internet comes, right? And then you get to 2001 and we just went like this. What happened in 2001?
9/11.
9/11 and the dot-com bubble, right? That's what they call it. And then we go, people lost a big, huge chunk of their whole entire life savings. Then it goes crazy again, and we get up here, and then everybody remembers 2008, right? People lost 40% of their whole entire life savings in 2008. Gone, poof, just disappeared and vanished. The whole time they're paying somebody else to play with that money, right? The whole time. Then, where are we now? We're not here anymore. This is 2012. We were way up here, right? We're off this chart right now. We were hitting records, the highest the market has ever gone. And if you look at the chart right now, you can see the peak. Because what goes up must what? Come down every time, right? So for me, I think a third grader can figure this out, right? What comes next? Up, down, up, down, up, down. Obviously, right? It's going to happen, and right now it is happening. your money that is put away in all these qualified funds, 401ks, IRAs, whatever it is that you have, most people have, everybody that you know, 10% of their entire life savings just vanished over the last 4 weeks. Gone into thin air. Who can afford to lose 10% of their life savings? Nobody, right? I sure can't. I don't know anybody that can. So Blue Line, this is, one size never fits all. And we always look at options for people that make sense. So Blue Line is one of the things that we do, and it's a really profound product. And I'm going to put a video on that's about that, so you don't have to listen to me stand up here talking about it. And then I'll go through some of the details of fill the blank. This one's a fun one too. It's a cartoon. It's really fun. I like this one the most, I think.
And by the way, the red line, blue line, the red line, it's not just as simple as up, down, up, down. Like economists say a market correction is a 10% change. Economists also say that a market correction of 10% changes happens on average every 5 to 7 years. And we've been on a straight upslope for about 8 years. So if you do the math and you listen to people that study this stuff, then, it's not just a pattern, it's bound to happen.
And the pattern there and the movement of the market is not governed just by numbers and statistics. It's governed by human nature. And if anybody can figure that out, let me know, because we'll be rich tomorrow. That's a good point. Yeah. So here's this.
When it comes to retirement planning, there are 3 kinds of people. The guy who doesn't think about or plan for retirement, you don't want to be that guy. The gambler type who feels the only way to grow her money is to risk losing it all in the stock market, and the play it safe type who shudders at the thought of losing a single penny of his savings, even if it means sacrificing any opportunity for that money to grow. For years, retirement planning has been vastly limited to choices that fall on one side of the scale or the other. And so, money-savvy people tend to invest in 2, 3, 14, 50 different products in an attempt to balance the scale. But what if there was a way to capture the upside potential of a risky product and the downside protection of a secure product all in one solution? Well, hold on to your potatoes. Let's talk about IUL. Index Universal Life can harness the best parts of both sides of the financial seesaw. IUL is a form of permanent life insurance that, whoa, hang on. Life insurance has changed in the last 20 years. You know it as something that just pays out when you die. But these days, life insurance can actually be one of the most powerful wealth accumulating vehicles on the market. One huge benefit of IUL is the ability to harness the power of compound interest to potentially generate large amounts of non-taxable cash value within the policy. This cash value can be accessed later in life to fund a happy, healthy, non-taxable retirement. Your IUL's performance directly reflects the performance of the stock market index while implementing a 0% floor and a market cap, usually around 10%. So your cash value participates in the growth of the market up to the cap and sits safely on the sidelines when the market goes down. You forego some of the upside to alleviate all of the downside. So 0 is your hero. With IUL, you won't spend a single day of your accrual making up for losses. Pretty cool, right? Well, it gets better. When designed properly, IUL can serve as a retirement vehicle based on a financial chassis of life insurance protection. And because of IRS tax code exemptions for life insurance, your cash value can create a tax-advantaged way to generate more income in retirement. That's something your 401k or IRA simply can't offer. So what might an IUL look like for you? Let's talk specifics. Larry here is in decent health, a non-smoker, and contributes $500 a month to his IUL starting at age 35. This contribution is conservatively projected to generate $500,000 of cash value by the time Larry retires at age 65. If he chooses to, Larry can turn on a non-taxable income stream from his IUL, giving him $60,000 of income per year to supplement his retirement. And the longer he waits to access this money, the larger it can grow. That death benefit is even accessible when Larry's still living if he suffers a critical, chronic, or terminal illness. So if Larry gets sick, he's covered. If he dies unexpectedly, his family is covered. And if neither of those things happen, the money Larry's paid into his IUL over the years can fund a happy, healthy, tax-advantaged retirement. Assuming Larry lives to age 90, he will have contributed a total of $186,000 into his IUL, drawn out $1.5 million in non-taxable retirement income, and still leave behind a very sizable tax-free death benefit for his heirs. The person who shared this video with you can show you what an IUL might look like for you given your specific age, health, contribution level, and retirement plans. Contact them today to get the specific numbers and see if IUL is a fit.
Okay. So what this is called is an IUL. And that's one of the products that we use to satisfy all the goals that we want to achieve for somebody by minimizing their tax liability, reducing their fees, and eliminating market loss. And we can say, which I feel great about, over the last month, not a single one of our clients have lost a dime, not a dime. But they're gaining in the market. And he said 10% in that video. We can do way better than that. So this is a new thing. Does everybody agree that technology changes almost on a daily basis?
Mhm.
Right? You get a new cell phone, and then 6 months later, the brand new one is out, and you're kicking yourself for not waiting 6 more months, right? That's what happened to me last time. So every single day, things have changed significantly over the past 20 years in terms of products and financial services. The whole financial world is different. So what this product particularly, we focus on this a lot, and like I said, one size never fits all, but this one is IUL. It gives you life insurance, living benefits, which we'll talk about in a little bit. That's very important. And a tax-free retirement. They mentioned all that stuff in the video. So how did this even come about, and why don't we know about it? That's what everybody asked first thing, right? So give me a click, Shane. Oh, what this does is it defends against market loss, defends against high fees and commissions, defends against tax loss, protects you in the case of critical chronic terminal illness, and also allows you to pass your estate on free of estate and probate tax. So another powerful vehicle for leaving behind a legacy. So give me a click. So the history, how did this even come about, and why does this exist? In the 50s, first of all, the tax code was written. Has anybody ever read the tax code? Nope. I can walk into an office, actually I did not long ago, walk into an office of tax professionals. Not a single one of them have read the tax code because it's 93,000 pages long. Nobody's read the tax code. I don't even know what's in there. You know, it's insane. But in the 50s, it was written. And there are tax codes in there that we know of and we use to help people get a tax advantage savings plan so that they can opt out of the tax system legally in retirement. Those two tax codes that we use a lot of the time, there's more, but we use 7702 and 101. And you can look those up and write that down. What those two say is that as long as you have your money wrapped around a life insurance policy to a certain ratio, you can put your money away, grow it, and then pull it free of tax. So you're getting tax-free growth on all your money. So that's what the tax code says. In 1976, a guy by the name of John Bogle, anybody know that name? Anybody heard of the Vanguard funds before? Yeah, Vanguard funds. That's a great big mutual fund company. He's the founder of the Vanguard funds. He also developed indexing, which is a strategy and method of investing. And I won't go through a whole lesson on it, but what he said, he saw all these brokers, they're buying, selling, trying to beat the market, trying to figure out human nature, being that that's what really guides market volatility. And he figured that you can't do that. So he said, forget it. I'm going to buy equal dollar amounts in all 500 companies of the S&P 500 and sit on it for a year. I'm not going to buy, sell, nothing. At the end of that year, he beat 9 out of 10 of those brokers. And they did studies and white papers, like professional papers. And I'm a science guy, so I look up all that stuff. And they said that indexing beats any other form of investment strategy 92% of the time after 5 years. So if you went to a casino and there were slot machines everywhere, anybody go to a casino there? Yeah, Rick does. I know you do, Rick. The slot machines. If there was one that said 92% win ratio, and the other ones didn't say anything, which one are you going to sit at, Rick?
92%.
Obviously, you're going to have to wait in a long line. So that's the one everybody's going to sit at because it wouldn't make a bit of sense to sit anywhere else. So indexing is clearly the way to go. Low cost and very effective. 1999, some laws changed. There used to be a law on the books called the Glass-Steagall Act. That said that banks could only do banking, insurance companies could only do insurance, and securities companies could only do stocks, bonds, mutual funds. Stay in your respective industries. Even though you're all financial people, don't cross the streams. Stay separate. So in 1999, they said, you know what? We want to give competition to the financial sector. So they removed Glass-Steagall and put in place the Financial Modernization Act, which allowed those 3 industries to go compete. That's why you can go to a bank today and get a life insurance policy, right? So of those 3 sectors, that's banking, insurance, and securities or brokers, which do you think came out on top when they started competing with each other? Banks? Nah. Anybody else? Yes?
Insurance company,
Yes, but why?
because of what they have to offer.
Yeah, I mean, yeah, it's risk management, right? They have more money than anybody else. Everything is insured. And the fact is 85% of global wealth runs through an insurance company. The Powerball is paid out by an insurance company. The banks have insurance on the buildings. They have insurance on the people in the buildings. They have insurance on the money that the people manage in the buildings. You know, everything on top of everything is insured. And then the insurance companies go buy reinsurance on all the insurance policies. So they can do things that the other two, brokers and banks, can't really offer because they have the financial backing and the power to do so. So they can provide guarantees and contracts that they don't even have the ability to do. So that was the next thing that happened. And then in 2000, the IUL was created after that law was changed. And then, you know, any new technology has kinks in it. So up until 2004, they're working out the kinks. And in 2004, it was nailed down and perfected. And it's still improving to this day. There's been changes in 2014 and 2015 that's allowed some really cool stuff to go on in terms of uncapped strategies. Remember how they said that a cap on some of the returns? Now they don't in some cases. So there's a lot of really cool stuff going on. And this product is a very powerful one for a lot of reasons. One of the most important reasons to us is living benefits. We think that everybody needs to have those. But Shane talked about it earlier, ensuring your income and protecting yourself. And I'm going to bring up our next speaker to talk about that. He's a popular guy. He's a pop culture Trey.
No, that's all right. Good evening, everybody. My name's Trey. I've been with the company for almost coming on 2 years now. And unlike Ryan and Shane, I do not have a degree of any sort. However, that's the great thing about this business is because I was once a relocation specialist, or other known as a mover. So, you know, and I mean, it's funny. However, it's great because I don't want to accept the mundane lifestyle. And an average Joe like me can come off the streets, and it doesn't mean that I don't have a burning desire to be somebody, to learn something, to enhance other people's lives. And I'm sure that you guys would agree. We can all get to where we want to be, so long we help enough other people get to where they want to be. Would you guys agree? And that's what really intrigued me about this business, is because it gave me the capability to do something that I'm truly passionate about, that I don't mind pursuing, that I don't mind dreaming about, that I don't mind speaking to people about. And I'm actually upset at myself right now because I haven't spoken up to enough people. Rick kicked my butt this week. He brought guests. I didn't. Coach brought guests. I didn't. And this is something that everybody needs to know. And what I'm going to share with you is my passion, why I'm in the business, and why everybody needs living benefits. And if you beg to differ, please tell me why. So by a show of hands, does anybody in here know somebody younger than the age of 65 that's had a heart attack, some form of cancer, or stroke, and survived? Okay, so majority of people. Alfred, do you know anybody that's had one of those? Amen. Majority of people do. I ask that question every week. I ask it to people everywhere I go. I see it everywhere in my life. And it's right up there on the board, as you can see. Fact is, 7 out of 10 people are going to have one of those big 3 before they turn 65. So that's probably about 12 to 14 of us in here. Who's it going to be? And we don't know. And next question: does anybody in here happen to actually own life insurance? I know, Rick, you do. Somebody that's not in the business. Ken, Alfred, do you do, Alfred? Okay, great. Do you mind if I ask you a quick question? What do you have to do to benefit from that life insurance? Yeah, what do you have to do to benefit from your life insurance policy right now? Yeah, amen, amen. So you have to die to benefit. So, what's that? Amen, amen. What if you could benefit while you're still alive, though, and it didn't have to wait until you die? Would that be better? Amen. And that's exactly what I'm about to share with you. Is what living benefits is in the case that somebody becomes critically, chronically, or terminally ill and has a life insurance policy like yourself, Alfred. I know you do, Rick. They now have the capability to access that money when they need it the most. Now, this is very new. It's only been in the United States for about 10 years. and it's actually in 53 other countries right now. So I don't know why we're behind the ball. However, it's something that is very imperative and can absolutely change somebody's life. I mean, can you imagine, Alfred, if you had a heart attack or a stroke and you couldn't go to work? I mean, I'm sure you're living pretty well. However, majority of Americans, I'm sure you guys can agree, if that were to happen to somebody, how would you maintain the same standard of living that you're living right now? Because I know that I wouldn't be able to. And not many people can. And you can see it right there. 78% of bankruptcies are due to medical expenses. Excuse me, over half of bankruptcies are due to medical expenses. And 78% of those people have adequate health insurance. So it's not a matter of not having health insurance, because the doctors get paid, the hospitals get paid. Who doesn't? We don't. And what Living Benefits is it bridges that gap between health insurance and life insurance. So when you can't go to work for 6 months and you still got to put your kids through college, you still got to pay a mortgage, whatever it is, you got to live. You can still live that same standard of living. And how it actually came about is two brothers, the Bernard brothers. They started open heart surgeries and major organ transplants. And this is a true story. They did a lung transplant on a lady in her mid-30s. She received the lung well. And they basically told her, look, don't go back to work, rest, recuperate, etc. You know, normal story. She came back for a checkup some months later, and she just looked deathly. She looked like very ill. And she said, you know, what's going on? The doctor said, what's going on? She said, Doc, you don't understand. I have 2 kids. I'm a single mother. I have to put food on the table. I got to work. I have to go back to work. They don't have a choice. Long story short, she ended up dying. She had life insurance that got paid out to the kids. I ask this every week too. Do you think those kids would rather have the life insurance money or their mother? Their mother, right? So it didn't sit right with the Bernard brothers, and they actually flew over to Europe, where they have big influence with the insurance companies, and they basically said, look, we're over here saving people, and you're over here killing them. Because you guys already have the money there on hand. You know, when you sign that contract, Alfred and Rick, they have to have 103% of that money. It's an insurance company. They're in the protection and distribution business. It's their job to pay you. They already got the money, so they said, why don't you give it to them when they can use it the most? And hence, that's where Living Benefits came from. So like I said, in the case you become critically, chronically, or terminally ill, you now have access to your life insurance money. And out of 2,700 different life insurance companies, there's only a handful that offer these at a no-cost rider. So it doesn't cost anything extra. And so, Rick, I mean, I asked you last week, there's 149 million people right now that have the wrong kind of life insurance that they have to die to benefit from. If they could have Living Benefits in case something were to happen to them, do you think they would rather have that? Right? Common sense. Same money, just better products. Why wouldn't you want to protect yourself? Because me personally, you better believe I own these products, because I have a son, I have a wife that I refuse. I'm young, I'm healthy. I know someday I could get sick though. And when that day comes, I'm not going to be a burden on my son. I'm not going to be a burden on my family, because I'm going to take the proper steps to protect myself. And like Shane said, pay myself first. Take care of my future. Take care of my family. And to me, it's imperative. Yet it's something that majority of Americans lack. And they already spend money on the wrong products. It's the same money from your left pocket to your right pocket. If we just moved it there and it's the same money, what's the difference? You're just getting better services. Why wouldn't you do it? And to me, that's truly changing somebody's life, because one day I'm going to bring a check to somebody for a couple $100,000 when they're sitting in the hospital and other people are bringing them get well cards. And that's when I know I found my calling, and I know I did. And that's why I stand up here every week and I tell my story, because I actually seen it happen in my own life. My mother had 2 strokes. I grew up very healthy, very lucky. Not a pity story, it's reality. And I'm sure you guys might know somebody yourself. And she did have a couple strokes. She survived. Was bedridden for a long time, ended up passing away, actually inherited what Shane said, a bad estate, and, you know, lost everything, became homeless. And it's not here nor there. I'm in a better place now because of this business, because I have the opportunity to go share this with people. And now I love life, you know, and I love the ability that we have here to make a profound difference in other people's lives and to share this information. What you do with it is your choice. I know that it's off my shoulders now, and I want to thank you guys. And to close this out, I'm going to go ahead and bring Coach Young on.
Thanks, Fred. That's pretty powerful. Every time I listen to him, I realize just exactly why we're in the right place at the right time. And, you know, the founders of all these companies, Empower and FBG, that's our insurance division. have a real big, strong crusade. And I'll let you know this, it's public knowledge now, but there are those companies that you just mentioned, Trey. There's like 2,700 insurance companies. There's about 25 of the biggest. And when I say big, they're worth a lot of money. Well, the chairman of the board, Alfred, of AIG is a big company. Would you agree? It's $350 billion in assets. So if any of you got $350 billion, stand up. That's why you're all sitting down, right? Well, this guy ran that, and he was called in to run it to fix it. And it's still big, and it's solid, and it's one of the strongest companies in the world, Ken. The guy's name is Jim Mallon. You can go Google him. He's pretty profound. He also was the chairman of the board of several other big-time insurance companies. So he moved, and the reason why I'm telling you that is he is the guy in the United States that's one of the pioneers of bringing living benefits here. They started with a company called LSW, then AIG. He just he resigned not recently in terms of retiring, turned over the helm, and he's sitting on our board right now. And the reason why he's sitting on our board right now is because he said, because I sat with him for a whole weekend, and I looked around and I go, what are you doing here? You know, you're a multi-millionaire. You've already done it. You built the big. There's nobody that serves in the places like you just did. There's not a lot of you. So why are you sitting next to me? And he looked at me and he goes, Alfred, because I'm not done yet. I go, good answer. Now, why isn't you aren't done? He goes, I don't meet too many other companies like yours that are marketers that have the same crusade I've got. And I see it here. I went and vetted all the people. I vetted the companies. I vetted you. And as a result of that, it's very impressive to me, and I want to help you, make you a household word. And I said, that's pretty profound. He goes, that's why I'm sitting on your board right now. Awesome. Now, listen to this. Coincidentally, I'm just telling you some stories. So you can get it in March, coming up. We'll give you the notice of it. That public broadcast, PBS, okay, they do documentaries all the time, as you well know. Well, they happen to call us up, and they want to do a special on annuities, another product that we offer for people. And the annuity business, as Alfred will attest to, has morphed and changed a lot in the last 20, 30 years. Would you agree to that, Alfred? Okay, huge. So they wanted to do a special on it. And Ron Blumenkemper, my partner and associate that runs FEG, the chairman over there, said, well, I don't think you guys are you're doing the right thing. He goes, what do you mean? Well, annuity. All the companies offer them. What you ought to be talking about is the thing that nobody understands in this country because nobody's got it for the most part is living benefits. They said, really, what's that? They go, what is it? So he told them. So sure enough, they fly him over, and James Earl Jones is a spokesperson. They're going to be a documentary with FEG and us. In their documentary, put out to 80 million people about living benefits because the American public doesn't even know it exists. You're going to see that in March. Consequently, we turned around and made a financial commitment. There's going to be about 40, how many we do? I think 40,000 one-minute commercials you'll see on Fox and ABC, NBC, CBS, all that in the month of March too. And there's going to be 100 commercials showing. So we're going to wake up this country. And we have the personnel to do that. And because they're identifying with our crusade, which is pretty cool. Now, all of us have been retired before. We all came out of retirement. Why? Because we're having fun. And you know why? Because I'm sick and tired of being sick and tired of letting the banks and the insurance companies and the mortgage companies screw everybody that's not educated in money. And most of us aren't. You go through life taking what you were told or not told, and then we complain about it. Why don't I know? Well, you don't know because your parents didn't tell you, and the educational system doesn't tell you either. And that is on our Facebook page. It was put there today through surveys. It's not in the educational system today. Not in grammar school, not in high school, not in college. Am I right or right?
Right.
Hello?
Right.
Right. That's the way it is. And by the way, I took some out just listening to you, and I wanted to see old school people say buy and hold. You ever hear that phrase? I'm going to have my mutual fund. I'm going to hold. It'll come back. You are brain damaged if you believe that. Now, if I'm insulting you, I'm trying to do it politely. How about that? Ain't that something? You can't buy and hold. Life is different today. You're being taken advantage of. Nobody should be making money on you like you're just giving it away. 1%, the Bureau of Labor Statistics will tell you this. 1% of fees on your is the equivalent lifetime of a 28% return. You're giving that away? Sign me up. I want to become your beneficiary. No. Money doesn't care who owns it. It only cares what you do with it. Am I right or right? Is that true or true?
Yeah.
All right. So, Tony, there's only one kind of money. You know what it is?
Money.
Okay, right. Money. Okay. Good answer because it almost is synonymous. I'm going to say not enough. Would you agree to that? Okay, it's a big time. And Albert, what'd you tell me in the car again? Albert has a great background, pretty influential guy, flexible guy. Business guy. He's got people skills. Believe it or not, you look at him, you don't think so, but you ought to listen to him talk, okay? But here's what he said. What'd you say to me on the phone about, or in my car? Tell him what you told me about being wealthy and broke. How did you say that?
I'd be broke, I'd be wealthy, but wealthy is better.
Wealth is better. So guess where he wound up? Going back for wealthy. You see, and he's telling me, I've had a lot, I've lost a lot, I've gained a lot. He's a man that's an entrepreneur, which is interesting to me, okay? I like people like that. So he understands the peaks and the valleys. And by the way, you said debt is an epidemic. Here's what I told. I got a hold of Malin, and I got a hold of Petro out there in Vegas. Come here, you two. I go, you're Mr. Crusaders for living benefits? Okay, cancer, is it bad? Yeah. Debt is the largest cancer in this country. Our nation is sick. $19 trillion. You have no idea. Right now, of unfunded liabilities, the truth is, it's $210 trillion. It means every man, woman, and child in this country right now owes $268,000 to pay that back. It ain't happening. And then you're all going to work wondering why things aren't right. We have a chance to right the wrong. So what do we do for people? Educate them. We told you that we had 6 steps to financial security. We told you we had 2 plans to do it. So what we create for people is an FIP. Everybody ought to have an FIP. In fact, Rick, what we've said, and you've heard it now, maybe now twice, everybody ought to have 2 dates, Greg, in their head. We believe that. And if you don't believe it, I want to know. Ready, Alfred? 2 dates you ought to have. Now, whether you were there already or not, I don't know, but I bet you don't have the 2 dates in your head. Everybody ought to have a debt-free date. How many of you agree with that? Being encumbered by any kind of debt sucks. It's stressful, it's a pain in the butt, and you're giving everybody else your hard-earned money away. Am I right or right?
Right.
Hello? Are you all with me?
Yeah.
Are you asleep in Francisco? So when I ask a question, you got to answer it, even in Mexican. Am I right or right? You're supposed to say sí. Okay. All right. So now where was I going? I lost my thought because I was busting his beans.
Debt-free date.
Yeah, thank you. Thank you. So a debt-free date. The other date is your financial independence date. Too many of you are thinking it's good enough for everybody else. You're living down here in Southwest Florida. Will you get your racks together? Are you kidding me? How everybody vacations here. Hello. How many of you bitch about the roads in the season? They're coming here to have a good time, and you're living here. You ought to live like why they're coming here. We were talking about that. Alfred's living in a place where people live every day like they want a vacation. And he's saying it. I like my vacation. I like this. I want to lay it back. I want to take it easy. And he is. Okay? So we make FIPs. Now listen to this. Listen loud and clear. This is big. 9 out of 10 people that we speak to don't spend a dime out of their pocket. One of them said, I can't remember if it was Trey or Ryan, it's simply, we're just moving money from your left pocket to your right pocket. That's all this is. And you don't even know what you're blowing. You have no idea what you're wasting. What you ought to do is do an analysis of your work. Am I right or right? So what is an FIP? Ken, can you tell them what that stands for?
Financial independence.
Yeah, see, Ryan's got one. Now, the truth be, he was a knucklehead because he's paying $38 a month for this. Truth is, this is $211 a month, but he only had to come out of pocket $38 a month. He's one of the weirdos, the one out of the 10, okay? However, for his plan, this is what he has. And so for $38 a month, here's what he's got. He's got $350,000 worth of life insurance protection. If he became sick or disabled or chronically or terminally ill, he's got up to $529,000, $529,000 in terminal illness, almost $600 grand available to him. You're allowed 90% of your deathbed if you want, and this is based upon a time frame. Pretty good, right? So if you get, that's what he's got available. But here's the biggie. At 66, when he stops paying into this thing, at 65, at 66, he'll draw tax-free to himself $103,753 a year tax-free. That and food stamps get you by in the weekend. Hello? For $38 a month, $103,753 a year tax-free. Most of the people in this room don't make more than $100,000 now. Only 4% of the United States population does. Let's wake up and smell the coffee. For $38 a month, he does. College-educated guy, master's degree, and they're going to pay him $38,000 a year. What a joke! That's why I like the example. I like your example, saying you don't have to have a college education here. You need to get an education. It doesn't have to be a college one. And by the way, got 2 of them myself. Okay, and paid for 2 college education too, and supported kids do it. They did a lot of scholarships on their own too. So it's about making use of your knowledge. How we doing? Hello, you all with me, Ken?
Yeah.
Are you bored, Ken?
I was wondering more about 66. It's $100 grand a year.
Oh, I figured you would. Well, you fill out a CNA, glad you asked that. Fill out a confidential needs analysis, put your numbers in, and we examine what you're doing so we can point out all the things that you may do better and find the money to make it work for you. And Ryan said it very well. One size never fits all.